All right, good evening, everyone. Welcome to the Hurley Investments market view commentary for the Tuesday, the 8th of September. We are just flying through this year. With that said, we came into a pretty big down week last week. And it's interesting because as I went through the down week last week, let me go to my my calculations. Last week, the market was down 2.31%, and Hurley Investments was down 1.72%, with most of our positions now protected and ready to go. So it was interesting as we sat through last week. All right, what are we going to protect? How are we going to protect it? How are we going to make it work? And it was a rather very tough week for us to go through and make decisions. If I was to bring up No Parker, we took a $255,000 hit on roughly 14 million. So 14 million, 255. Still waiting for some things to come into place. If I could do my calculator, 255 divided by 14. 1.82% on a 2.78%. So we're making up 60% plus of the downward movement right now. That should only get better as we continue to move farther down. How much farther down are we going to move? That is a very interesting question. As I put in our indexes here, I would have thought we would have stopped already. In all honesty, I would have thought, hey, pullbacks, we've kind of had enough. We went the full 10% on the NASDAQ, but we are definitely technically bearish on the Dow. Now the Dow's only 30. It's not a real index. No one benchmarks against the Dow. It is what it is. But it was interesting to see how we're starting to maybe hold up a little bit against the 50-day. Now, I'm just noticing that, right? Technically, we have our crossover. I'm sure we have it here. We just got it on the MACD, but we're now oversold on the Williams percent R. I was thinking maybe if Lululemon had done a little bit better today, what else was the one that had the earnings? As I'm trying to get to it, wasn't Lululemon though, it was AstraZeneca, but there was another one. Oh, what? So I guess I don't know what I'm talking about. With that said, the futures right now show the S&P down 0.4%, so 0.4%, down 1325. Right after the market, about it was twice as bad as that an hour ago. So Dow Jones is bearish, 4 days, pretty big drop. I have an article I'm going to reference here. but it is what it is. The short answer is we always knew this was coming. The August, you heard me say over and over and over again, I don't get it. I don't understand, but we're going to keep going up. We're getting ready to protect. You know, we could have protected 5 weeks ago, 6 weeks ago, and we would have missed a huge run up, 9% on the S&P 500, and that just would not have been the best thing to do. I'm going to go over that in a quick second, but if we look at the S&P, we did come down and basically touch the 50-day. Tomorrow's going to be a telltale. If we break our 50-day at 3305, which most likely we're going to open up below that, we're going to go down and touch 3093. And I guess I would feel more comfortable if we would head down and test the 200. Comfortable meaning that could erase most of August, and August seems to have been buoyed up by SoftBank. I'm going to show you an article on that, but we are artificially inflated through options to the tune of $4 billion by SoftBank, which has a multi-trillion-dollar effect because you're leveraging that money. When you leverage that money, it affects the stock market. So plain and simple, we're looking at a pretty quote unquote inflated, artificially inflated August, which we now need to recoup, or for all intents and purposes have a pullback on. And then if I pull up our NASDAQ, we're down a full 10%, so we already have our correction on the NASDAQ. And having our correction on the NASDAQ, we I guess we're good to make our next run up. And I'm going to show you a couple different things that I've seen that kind of go over what we've talked about. We can't, I mean, for all intents and purposes, we are below the 50-day. On the NASDAQ, it closed at 10,847. The 50-day is 10,880. So we are below the 50-day for the NASDAQ. I don't know if I see us going all the way down to 9,363, but I could see us going down and touching a round number like at 10,000. And I'm literally just picking numbers right now. I'm picking numbers because in August, 100% unexplainable exuberance. It just did not make sense. And I'm coming back now saying, hey, I'm just looking for herd mentality numbers that may justify where we're going to continue to head down. I don't know. As I go through the market recap, we added jobs. I mean, in all honesty, I don't spend too much attention to this area. It's for you guys to read. I've got a different article that I found more interesting that I'll put in here. Here it is right here. Dow dropped 600 points as tech stocks fall again. NASDAQ down 10% in 3 days. Our indexes were never meant to work this way. Our indexes, just plain and simple, are not here for this at all. It's just not the way they're supposed to work. But that's the way they are working right now. NASDAQ dropped 4.1% to end the day at 10,847. It has its correction now. Excuse me, it has its pullback. Its correction would be down to 20. But a full pullback is in place on the NASDAQ. Unfortunately, it does not look like that's going to be enough. We look like we have a down day tomorrow. It'll be interesting to see and watch where things go. The Dow plunged 632 points to 2.7%. The S&P slid 2.8%. Basically, the S&P is down 7% over the last 3 days. Its worst stretch since June. You know, to blame it on Tesla. In fact, another interesting article that will attach at the back end here really comes down to the 6 biggest tech stocks: Apple, Microsoft, Amazon, Alphabet, Tesla, and Facebook were up as high as 8.2 trillion at one point in time. Now down, where is that I read? 8.2 trillion. They now have combined index market cap of 7.1. So huge losses on the 6 biggest tech companies. But these 6 tech companies for mostly, how would I say it? These 6 companies accounted for the majority of the gains year to date. Without these companies, the S&P 500 would be down. Now, we trade Apple, we trade Facebook, we have traded Microsoft in the past. We really don't trade Amazon or Tesla. Neither one is fundamentally sound. And Google is literally just too expensive. It's just too expensive. And to put a couple of these things into place, I'm going to quote this article. In general, if you think about the market cap loss over the last 3 days for Apple, it's about $325 billion. To put that in perspective, that's 1.5 sales forces, CRMs, right? Or it's equivalent to Apple's projected revenue for the next calendar year. These are ridiculously huge numbers. It's just ridiculous. I also kind of giggled because, and I'll get to that question here in just a second, Abraham, or that comment. I giggled because Jim Cramer, come on. Jim Cramer, I'm planning for a market rebound from the sell-off. Take something off the table. Well, in general, we had that already planned. We cashed in a lot of our leaps last week. We are more or less cash heavy in accounts. But if you remember me going all the way back to February, March, my comment was we probably won't show our gains for the year until after November, until after our election. That'll be when you might want to push some big money in. And it's unfortunate because our election results are probably going to be a couple weeks delayed before we know who truly has won the election. I can't remember, but it's 6 or 9 states that are mail-in voting. It's just absolutely friggin' stupid the way that we're going to run our election. And it's going to be a bummer that we're going to run an election for the first time in history. Well, that's not fair to say either. We're going to run our election in modern times and not know who our winner is until most likely weeks after the election. That's going to be a big change for us. So I have more articles than I usually do, and I found it interesting because worries grow over a K-shaped economic recovery that favors the wealthy. So you've heard me say we might go down and do another 20 to 35% drop, which means we kind of had our gain. We had our 35% drop. We're kind of coming up to it again. And chances are we could drop and come back. I would call that more of a W. A double bottom, right? That's what we're truly looking at. We're looking at a double bottom testing the lows of the year. I don't know what a K-shaped recovery it looks like. I don't know how you would draw a K-shaped economic recovery. But of course it favors the wealthy in some way, shape, or form. I think, in all honesty, the difference is that maybe the wealthy, however you define the wealthy, has more money to put in the bottom. And I think that's where our collar trading will favor those of us who are everyday Americans. Let's face it that way. We might call ourselves middle America. There are a couple of you that have millions that are with us here tonight that still are probably middle America. You're the upper end of middle America. Let's face it. But the way that we protect on the way down or try to make something on the way down is going to benefit us because we have some cash to put in at the bottom. Some cash that's significantly different than, and I'm going to apologize the way I say this, than a paltry 401k deposit of $500 a month to hit your $6,000 catch up for an IRA or a Roth. Those numbers are so small they don't affect accounts. Whereas when you're talking about having 20% of your account in cash, you have the opportunity to look for a bottom. And we will start nibbling at that round number. We might stick 5% in at that 3,000 number, 33,098 200-day average on the S&P, 10,000 on the NASDAQ. We might look for a 20% drop to nibble. We would look for that double bottom drop to nibble. And again, a lot will depend on our election results. I found this article pretty interesting, just something that I think will benefit you guys because we're creating cash and don't have to be 100% invested to be able to put you into potential bottoms is the best way to say it. All right, SoftBank identified as a NASDAQ whale that bought billions in stock options, betting on higher prices for the names in tech. Plain and simple, if you have $4 billion in options, multiply that times 100. $4 trillion of market cap was invested to the bullish side. It obviously pushed August up. You heard me say for weeks, I don't understand, but we're prepared to add protection. We're prepared to take profits. We did it on our first down day. We're now on day number 3 or 4, and we're ready for the drop. But through their vision fund, $4 billion in options is like $4 trillion in market cap. When you multiply it by 100, it explains why we're going to go through some volatile downward swings. As those profits are taken and as they trigger at such big numbers, as they trigger algorithm trading, it's going to be ugly. And in all honesty, to back 9% up usually brings you out to an 18 to 20% drop. So if this is 100% correct, at the 20% drop mark is where I really want to nibble, take some profits, and start reinvesting that into more stock. I wouldn't expect the NASDAQ to pull down the S&P, but right now that's what's happening as it seems like the NASDAQ and the S&P are being hedged against each other, would be the best way to say it. Very interesting article. Make sure you read about it. We're certainly in a bubble. Interesting article. I would suggest you do read this one. It just, again, one more time, talks about valuation. And when you stretch valuations on companies to areas that they're not supposed to be at, all of the programs for financial planning, all the programs for portfolio management, all that get thrown out the door. When you have one input so out of whack, it screws everything up. And that's when you start hearing people talk about bubbles or valuations. They don't really know how to explain it. It's just that, yes, we're toast. I found this article. Yes, the crash is coming. We've talked about it. Here are the numbers that justify it. A very good article. Please spend your time reading through this when I get it posted later on tonight. Tesla could be the most dangerous stock on Wall Street. I just put it in here because I'm not a fan of Tesla or Amazon. When you're not fundamentally justifying your PE ratios, your future guidance ratios, when you're valued at more than companies that are selling millions of cars for your 400,000 that are sold and less than 100,000 in a year, I'm going to call it what it is. It's bullshit. It's ridiculous. But look at stupid people trading. You kind of drink the Kool-Aid and, oh, it tastes good, it tastes sweet. It's going to keep going up forever. This is the garbage on some of these stocks that I don't understand. If it's not fundamentally sound, I can't find a way to put my money into it. I'm not going to put yours into it. China accused U.S. of bullying as it touts its new global data security push. Read the article again. Its new data security push does nothing that really justifies. It's so weak, it's ridiculous. It's a joke. Read it. Interesting read. And tenant scores 20 million business domestic openings since the pandemic ended. I really hope when you saw Disney's push against the market today, Under Armour's push against the market, Ford, we actually had a couple fundamentally sound companies that pushed against the market, which was amazing. Usually all these stocks all fold. It's been a while since I've seen on our list 3 or 4 different stocks end up in an ridiculously ugly down in the stock market. Disney up $2.21 or 1.67%. Rather unique in a big down day that you'd have Disney up. Ford was up 1.88%. It's only 13 cents, but it's back above $7. And Marvel Technology Group was up 19 cents. It's 0.5% for them. Newmont Corporation, Newmont Mining up 42 cents or 0.64%. And Under Armour up 0.52, 52 cents, up 4.99%, up almost 5% in a single day. It's really neat to see stocks that we trade that are at these levels. If I went back through again, Visa held 200. I feel that would be important. Target held 144, a support level to the penny, right on the nose. I think that's important. Starbucks is still above 85. Micron is still above 45, and it's an intra-month low. Eli Lilly almost held 150, was up for most of the day. Key Corp held 1250, holding at 1252. JP Morgan almost held 100, but it did break it. It's at 99.92. FCX couldn't hold 16, but it's above 1556 at 1572. Facebook, again, will probably go down to 250. We'll get back into leaps then. It's down at 271. And where's my other one? Baidu almost held 120, but it's close at 119.31. Bank of America almost held 25.50 at 25.48. We do have long put protection on it. Boeing broke 166. So when it broke 166, the bottom down is to like 144. We had protection added on to Boeing today. And Apple's back down at 1182. 112.82. Probably 110 is where you're going to see some buying in on Apple. So I'm just going over this with you right now because my simple answer or comment comes down to this. I think our markets are going to end lower this week. When we have such upside exuberance, awful spelling, I'm sorry, I'm a college graduate. We get the same reaction times 2 on the way down. And so what we're doing, I've had it on for weeks, still letting listings run, preparing protection gets through October, the new protection for the election. I'm also going to take profits on lead calls and be more cash heavy opportunity to buy. All of that is done. All done and mostly protected. We're there. We're cash heavy. Profits were taken. The neat thing about what I do, I'm not required to have 98% of your capital invested, 96% invested. I can sit back and I can let some of these things happen. Now, there is something that was important because some of you are going to ask me, and it was already asked earlier, Kevin, so this was my question of the day, right? Question of the day. Why haven't you sold off our profitable stock positions as well? So I'm going to answer this in 2 different ways. It will create a taxable event. Now, the next question to follow that, will so does selling off our leaps? And it does. And some of those leaps have been in there over a year. But most of the stock has been in over there for 2, 3, or 4 years. So it'll create a huge taxable event. The second answer comes down to this very simple numbers that I've said forever. And I finally have some numbers and some that'll back it. I got this from the CNBC 3 Types of Investors video. And here's what it comes down to. In the last 40 years, if you missed the 5 biggest days in the market, you missed 30% of the gains. If you missed the 30, I'm going to change that to best days in the market. Best days in the market, you missed 70% of the gains. So the comment is, or has been, we don't ever miss an up day in the market. pretty simple. I get a profit for you in the stock. I convert that to leaps where we leverage our money. And then I repeat the process over again when we have these market crashes. These market crashes happen every 4.4 years. We just went through one of the longest bull market runs in history. Things are going to start getting more normal. We might have these crashes every 2.2 years. We're prepared. We'll get our protection on. We're not going to sell off our big stock positions unless it's voted accordingly. So that's where we're sitting at this time. So 2 quick questions were come in. And obviously, both of you are kind of rather new, so actually I'm going to do 3 of them because I think it'll help all of you. Here we go. Could losses in Apple and other China-related stocks have fallen due to Trump's decoupling of China? Possibly, but probably not. What I mean by that, Verizon just did a Samsung deal worth $6 billion for 5G. So plain and simple, probably not. At least the numbers don't show that yet. In fact, if you have questions, now's the time to please type them in. Pretty interesting comment, and this is from Abraham. Indexes should be equal weight for showing market general behavior. Correct, but sometimes they are not weighted that way, so it looks differently. Comment was made at September. Historically, the worst trading month. It's actually October's the worst trading month. September's the 3rd worst, with February being the 2nd. So, could we just miss those? Because that's the next question. Kevin, why don't you just sit out September and October? Because that gives us the ability to pick up more shares, which will probably go into the next question. Someone's going through their account saying, but Kevin, Apple's down, Boeing's down. These protective puts are not yet generating 65%. So my comment is, no kidding, give them time. Would we not be better off if we were just able to harvest 65% of the loss in the security we're trying to protect? No. In fact, it's all but impossible to pick the bottoms or tops. We never pick the bottoms or tops. We attempt to, and sometimes when we miss on the bottom, we make up something on the way down, and we add 100 shares, and we got to add puts back on again. So it's a balancing act. And the next question is equally as good as the one I just read. But Kevin, what if the puts don't make up 100% of the downward movement? And the short answer is the puts will never make up 100% of the downward movement. So if you're told that or taught that, you were taught wrong. They can't make up 100% of the downward movement because even if they went way, way, way in the money, you paid a certain dollar figure of intrinsic money for those puts. So for that matter, plain and simple, how do I say that? So let me put it this way. The fact that we can make up anything on the way down puts you ahead of anyone basically doing anything else. And that's a simple answer. Next question. Seems we're not able to always put them on or take off the protect puts in a timely manner. Missing those tops and bottoms is a balancing issue. No shit. Duh. In fact, you'll never hit the tops or the bottoms. It's what portion of the wave can you make? And again, if it doesn't work for you, good luck. That's the short answer. Yeah, you're never, guys, it's really difficult to compete against an education that's not trading real money. And please, under no circumstances did I ever tell anyone that we're going to hit tops or bottoms ever. Our goal is to capture a portion of the wave and create wealth like the Warren Buffett way. To do it through warrants like he does it, but we do it through the options. To be able to add shares on the way down, to have it bounce back higher when they come up. I will always miss the tops and the bottoms. And if any of you think at some point in time that I said that I would hit them or that someone else would hit them, you 100% misunderstood, and you 100% were fed a line of BS. So we do the best we can through our technical analysis. We do the best we can through our common sense. We nibble at times. We look at support levels at the times, but common sense tells you support levels and resistance levels break all the time. Common sense will tell you that technical analysis is a social science, not a real science. And the neat thing is, we do a hell of a job, and I love it. We do a very decent job. If we're ahead, we should capture harvest protective puts and some gains. 100% true. There are times that's possible, but it depends what those protective puts are doing. So you'll notice the other day, we actually harvested profits on the covered calls where we only had them on for a day or two. I think we picked up like $1.20 on Visa, and I can't remember what, I think Apple is the other one where we harvested $3 or $4 on Apple calls. But protective puts, those gains are not important. Those gains are nice. Protective put gains hedge our bets. It gives us extra shares, but a protective put is protecting stock ownership. That when you look at a pretty, let's put it this way, as you look at a couple of those gains, they're pretty piss poor compared to the total amount of cash you have in the stock. So plain and simple, no. If we're ahead, you should never harvest your protective puts for some gains. You should see a support level or an area that you have a probability of bouncing higher. That's a difference between a protective put, and that's a difference between, you know, amateur trading. Oh, a profit here, and you take it off and you lose 5 times that amount in the next 20 minutes on the way down. Great questions today. Any other questions that I can answer for you? But good questions, guys. I don't see any more coming in. With that said, I'm gonna run back over to my parents and see what I continue to do to be of help. Kind of interesting. I got a couple of you texting on the phone. I appreciate that as well. Guys, have a good evening. I will get this posted here this evening. So tomorrow morning, I'm going to add in those other couple of articles just so you can read through them. And the neat thing is, welcome to the process. The down process is supposed to hurt. anything we can make up on the way down is a profit when things come back up. That is the way the process goes. And the neat thing is, the more we can make up on the way down, the more shares we can pick up without having you investing more money into it, is more money when things come back. That's just the way the game is played. Guys, have a great evening. I appreciate all the questions, and I will talk to you probably next week. Key will be taking over the Thursday, as I'm probably still here in Houston throughout the week. He might, even if I'm on the road on Monday, I will most likely get back on us for our commentary next Monday, and I should be back home next week. Take care, guys. Have a good one. Bye-bye.